Hey, DataCat here. So the US government is in talks to buy a direct stake in Intel. You saw the headlines? You saw the stock jump over 7%. Most people are calling this a bailout, a simple rescue for a company that's been struggling. And that, my friend, is an interesting story to tell. Something I think would only happen under Trump administration. Okay, if you don't want to listen to a random guy on YouTube hiding his own face, here's what my 2 cents for you. I don't think this is a simple financial rescue, but instead part of a massive fundamental shift in American industrial policy. The government is deliberately creating a state-backed national champion to compete directly with China, and this could completely change the rulebook for investing in big US tech. For those of you sticking around, thank you. I know the channel is new, only about a month old, and the support has been, well, it's been more than I expected. I'm DataCat. I spent a long time as an analyst inside a Fortune 50 company, staring at spreadsheets until I ran out of coffee. I guess you could say I've traded the corporate grind for lasers and keyboards. I'm not really one for the spotlight. I'd much rather just dig into the data. So your being here means a lot. If you appreciate this kind of no-hype analysis, maybe consider subscribing. It really helps a small channel like this one, land on its feet. Alright, so, the government and Intel. What is actually happening here? The key word is equity. The government isn't just giving Intel a loan or a grant. They're talking about taking an ownership stake. It's like the difference between leaving a bowl of milk out for a stray and actually adopting the cat. They're not just feeding it, they're taking it back home for some private cuddling session. The immediate reason is to pump enough cash into Intel to get their massive mech and very delayed factory project in Ohio back on track. For those who don't know, this plant is supposed to be the cornerstone of bringing advanced chip manufacturing back to the US. But this move didn't just, appear out of thin air. There's a much bigger story playing out. First, you have to understand that Intel for a while now hasn't been the top cat. They were the undisputed leader for decades, but they've fallen behind competitors like TSMC in Taiwan. They've been having a tough time financially, cutting spending and delaying huge projects like that Ohio plant. Then there's the big one, geopolitics. The real driver here is the strategic competition with China. Semiconductors are the bedrock of everything. Your phone, your car, the entire modern military. They are the catnip of the global economy. And the US has become extremely uncomfortable with how much it relies on other countries, especially Taiwan, to make the most advanced ones. And this isn't a one-off event. The administration has already done similar things. They took a golden share in US Steel to approve its sale, and a major equity stake in a rare earth company called MP Materials, which, if I remember correctly, shoots up its stock price. The politics of it are also something else. Just days before these talks, President Trump was publicly calling for Intel CEO Lip-Bu Tan to be fired. Then suddenly they're meeting to discuss a strategic partnership. This tells you that a pragmatic, deal-focused mindset is taking over. And the fact that the factory is in Ohio, a politically important state, is certainly not a coincidence. So when you put all these pieces together, you get the real thesis, what Wall Street might not be telling you. The proposed government stake in Intel is not a bailout. It is a deliberate escalation of a new interventionist American industrial policy. It's a strategy that blurs the lines between the government and private industry to create a national champion in a critical sector. The reasoning is pretty clear. 1. It follows the exact blueprint they use with MP Materials. It's a combination of direct investment, the government promising to buy chips, and a strategic partnership. The goal isn't just to save Intel, it's to give it the full backing of the US government so it can compete on a global scale. It's a direct mirror of the model China has used to build its own tech giants. 2. This shows that geopolitics is now more important than traditional free market ideas. I mean, for decades, the idea of the US government owning a piece of a major public company like Intel would have been unthinkable. It goes against everything American capitalism is supposed to stand for. The fact that it's happening shows a deep shift in priorities. The administration is saying that when it comes to industries that are vital for national security, it will not leave the outcome to market forces alone. But this path is loaded with risk, and this introduces a new kind of volatility for investors. Think about it. The president was attacking the CEO one week and partnering with him the next. What happens to Intel's long-term strategy if it's suddenly tied to election cycles or political favors or even a single social media post? This could make the company's direction dependent on politics rather than business fundamentals, which could scare away other investors and stifle the very innovation it's supposed to protect. It forces you, the investor, to price in a level of political risk that you've never had to for a blue-chip American tech company. Now, we've covered the what and the why, but the real question for any investor is the how. The execution. We know Intel's Ohio project is delayed to the early 2030s. We know its foundry business needs customers. And we know the existing CHIPS grants are politically messy. These are the facts that make a government stake so meaningful right now. So let's get into the technical side of this. The chart. Because a story is one thing, but the market's reaction is, where the money is. What we saw with Intel is a classic news-driven explosive breakout. The stock's chart has been fundamentally changed in a single day. It went from a weak downtrending state to one of bullish momentum. But, and this is a big but, this powerful move is running directly into some heavy resistance, and the longer-term picture is still pretty gloomy. The next few days are absolutely critical. And remember, this is not financial advice, I'm just here to help you make better decisions. Alright, first, let's look at the explosive move itself. The raw numbers tell the story. A daily change of over 7%. That's a massive one-day gain that makes everyone pay attention. But the engine behind that move was the volume. 184.2 million shares were traded. That is 1.78 times the 20-day average. When you see volume like that, it confirms strong institutional participation. This wasn't just retail traders. The big money was making a move. The stock broke clean out of its recent trading range, which signals the old downtrend might be over. Next, you have the momentum shift, paints a picture of a dramatic reversal. The 10-day RSI journey is really telling. It started the month in the oversold territory, down at 29.8, and it has now rocketed up to 66.2. That is a violent shift from extremely bearish to bullish momentum. And the MACD histogram, to avoid confusion, I didn't show it here, is also expanding, which confirms that this bullish momentum is actually accelerating. But here is where you have to be careful. We have to look at the trend. This is a bullish battle happening inside a bearish war. The price closed about 10% above its 2050 and 200-day moving averages. Clearing all of them in one go is a powerful short-term statement. However, the slope of the 50-day and the 200-day moving averages both are still pointing down. This is crucial. It tells you that while the one-day move was great, it happened within a longer-term downtrend. The bigger ship is still pointed south. And remember, a death cross happened back in May of 2024. That's a long-term bearish signal that is still technically active. It's like a shadow still lurking in the corner, reminding you that the bulls have a serious challenge ahead. Finally, let's look at the candlestick for the day. It tells a little story about the intraday action. The stock gapped up on the news, but it failed to hold its peak price for the day. The candle has a strong body, but also a noticeable upper wick, and the price closed 1.4% off the session high. This is a gap and fade pattern. It suggests that some traders started taking profits as soon as the price surged. It's not necessarily a bad sign, but it shows you there are sellers waiting at these higher levels. So, what should you watch for next? This is a pivotal moment. The catalyst is a rumor, not a done deal, which adds another layer of risk. The bull case is simple. The bulls are in control for now. The sheer force of this breakout suggests the path of least resistance has shifted upwards. Their main job is to defend the area the stock just broke out from. The bear case, or the cautionary notes, are that the long-term trend is still down. The gap and fade shows selling pressure, and the whole thing could fall apart if the deal doesn't happen. A failure to hold this breakout could create what's called a bull trap, and those are painful, so here are the key levels you need to watch. The crucial resistance zone is between $23.83 and $24.20. The stock closed right at the bottom of that range. This is the most important battleground. A convincing close above $24.20 on strong volume, say over 1.2 times the 20-day average, would be a major confirmation, suggesting the price could continue up towards $25.50. The immediate support zone, the floor, is between $22.44 and $22.88. This was old resistance that should now act as support. If the price can hold this level, while the RSI maintains at about 55 for the next 3 to 5 trading days, it would be very constructive. And then, the line in the sand again. This is the zone between $21.65 and $21.86. A close back below this level would negate the entire breakout. It would be a signal of failure, and the price would likely fall quickly back to the low 20s. In summary, the explosive move is on the board, but the job isn't done. You need to watch for confirmation. Look for the price to either consolidate above roughly $22.90 or break decisively through $24.20. If you see the volume start to fade and the price drop back below those moving averages, that would be a significant red flag. This is the kind of setup where patience pays off. You don't have to be the first cat to the ball. Let the market show you what it's going to do next. If you found this breakdown useful, hitting the like button really helps the channel out. And if you want to keep digging into the data behind the headlines with me, consider subscribing. Alright, DataCat out, stay sharp and stay safe out there.